Good morning. Today we're going to look at the year in review and look ahead 6 planning ideas for 2021 and beyond. I'm going to, for abbreviation, go right to the meat of the matter here with planning ideas for 2021 and beyond. There are 4 elements that are complicating our planning. Presidential election is over, so that's a known entity. We have recent legislation with the Secure Act, CARES Act, and Tax Cuts and Job Act of 2017. We have historically low interest rates and historically low tax rates that are subject to change. So here are 6 planning ideas for 2021 and beyond. Review your portfolio's asset location and asset allocation. Understand the need for tax planning, retirement planning for peace of mind, estate planning is making a comeback, general planning, the tried and true, and don't forget distribution planning and Roth IRAs. So let's talk about each of these components. Review your portfolio's asset location and asset allocation. The new year is here, so let's take the opportunity to prune your portfolio and make any additional changes. Asset location is different than asset allocation, and both matter. There are 3 main types of accounts: traditional IRAs and 401ks, Roth IRAs and 401ks, and taxable accounts. Unlike taxable accounts, a traditional IRA and 401k are tax deferred, and a Roth IRA and Roth 401k are tax-free, as well as tax deferred. We have traditional IRA and 401k accounts. You must start taking required minimum distributions from traditional IRAs once you turn 72. And these required distributions will be taxed at ordinary income tax rates. Therefore, using assets that tend to grow slower means your RMDs will be lower. With Roth IRAs and 401ks, with so much uncertainty connected with future tax rates, Roth accounts make a lot of sense for people in high tax brackets or whom are worried about taxes in the future for themselves or their partner or their children. It serves as a great hedge against future tax rate increases. Taxable accounts. The reason stocks are better in a taxable account is because of the growth that they have, as well as the lower tax rate typically for capital gains compared to income tax. Tax efficient funds such as municipal bond funds or funds that generate little to no dividend income, such as an exchange traded fund or an index fund, can also be held in taxable accounts. Asset location and taxes. You may want to take a picture of this slide. Different tax treatments exist for different investment vehicles. In this very uncertain tax environment, try to direct money to tax-free investments when possible. According to Goldman Sachs, a 60-40 portfolio is estimated to return about 4.2% annually for the next 10 years. This means 60% stocks, 40% bonds. Those that simply purchased index funds may be disappointed in the next 10 years. Goldman Sachs predicts market returns will be based on earnings growth and not necessarily multiple expansions. So what does that mean? It means that we need to take on a little more risk. There is a poor outlook for bonds. Remember, bonds operate like a seesaw. Interest rates go up, bond prices go down. Interest rates go down, bond values go up. So the bull market in bonds is likely to be over as yields are unlikely to decrease. Risk is not a dirty word. In fact, it is necessary to have risk in order to beat inflation. So determine which risk you will assume. Is it credit, liquidity, manager, currency? When we meet for our meetings, we go over your risk tolerance and what type of portfolio is suitable for you. But in the next few years, most likely you're going to need to take a little more risk. Let's look at your portfolio as a three-legged stool. We need to have some growth in there. We also need to have some recovery stocks. Maybe some stocks that have been out of favor. For instance, like Disneyland. Disneyland's been closed during the COVID crisis here. Disney might be an example of a stock that is a little undervalued right now. Hotel stocks, airlines, those are recovery type stocks. Non-correlated alpha ideas, this can be a combination of strategies designed to be non-correlated, stocks that don't necessarily perform in tandem with the stock market. These strategies would include emerging markets and international funds with active managers, as well as some credit opportunities, environmental or renewables, hedged equity, or long short funds. Understand the need for tax planning. Item number 2, tax planning is a year-round activity. The Tax Cuts and Jobs Acts provided exceptionally wide tax brackets that investors should be leveraging, whether for tax bracket management or Roth conversions. Many underestimate the benefit of capital gains planning. We have 3 different rates for capital gains: 0, 10, and 15%. Again, we want to fill up your bucket with capital gains and take advantage of the lower tax rate of capital gains. Retirement planning for peace of mind. It's not how much you make, it's how much you keep after taxes. A good plan will help you get there. So looking at retirement planning, some tax strategies to help you with retirement planning. You have QCDs, qualified charitable donations. If you're over 70 and a half and you don't need your required distribution, or you want to prune some money out of your IRA or make a donation, you could go directly from your IRA to the charity and not have to report that income. Roth conversions, again, we need to fill up tax brackets, and a Roth conversion may make sense. And then the Secure Act makes large traditional IRA balances dangerous. Why is that? In the past, beneficiaries could stretch an IRA distribution over their lifetime. Now, when you inherit an IRA, you must take that money out within a 10-year period of time. This can create a tax burden on a beneficiary. Here are employer retirement contributions. One thing I'd like you to pay attention to is if you have a 401k, does your 401k plan allow for after-tax contributions? This can be a huge planning tool for you in the future. The 401k contributions remain the same, $19,500. If you are turning 50 this year, you get to take advantage of the catch-up provision. You don't have to be 50, you just have to be turning 50 this year. And you have HSA that went up a little bit and catch-up provisions. So estate planning is making a comeback thanks to politics, shifting tax laws, the Secure Act, and the sunset of the Tax Cut and Jobs Act. Estate planning is in the front burner again. And there are lots of reasons to be engaged in estate planning, tax and otherwise. And many people neglect this very important area. Estate planning items. We may take a look at some gifting strategies, deathbed planning, never very fun, but sometimes this is an option, and post-Secure Act estate planning. Life insurance is becoming a very important component to many financial plans this year. And also a beneficiary review. Make sure you've looked at your beneficiaries and they're accurate. I usually recommend having a primary beneficiary and a contingent beneficiary. General planning, the tried and true. In the middle of all the activity, don't forget the tried and true. General financial planning, making sure that you are on track to meet your financial goals. And this is what I try to do on a regular basis with you, is to make sure you're moving forward and reaching your goals. Also, if you encounter a major life event such as a family change, job change, moving, retirement, death, marriage, life events typically necessitate a review of your financial plan. And don't forget distribution planning and Roth IRAs. Roth IRAs remain one of the best ways to create multi-generational income tax-free wealth. And with taxes on the rise, there has never been a better time to consider a Roth. 7 reasons to love Roth conversions, Roth IRAs, and Roth 401ks. Look at your, if you are contributing to a 401k, check your plan documents. Do you have the ability to contribute to a Roth 401k? If you have a question about that, again, give me a call and I can help you with that. The reasons to love a Roth is you have concern about higher taxes in the future. The amount that you convert is expected to grow. You're concerned about large required minimum distributions. Roth IRAs are not subject to required minimum distributions. You're concerned about the IRA impact on your heirs. A widow's penalty, when a spouse passes away, instead of filing jointly, you are now filing single and your taxes go up. And the Secure Act. Mathematics of Roth IRA conversions, we have tax buckets, and this is something that I review with you when we are talking about conversions. I call it Goldilocks. What's the right amount that you can convert without pushing you into a higher tax bracket? And the key takeaways from today's presentation is your financial plan isn't based on the idea that a Republican or Democrat will always be in the White House. The market is generally impervious to the president. The market is driven more by fundamentals, interest rates, and the economy. Most likely, in order to get a better return, you're going to have to take on more risk. And consider high conviction strategies and determine which risk you will take on. What do you feel comfortable with? And this is something that I review with you during our progress meetings. So again, to recap, review your assets allocation and location, understand the need for tax planning, retirement planning for peace of mind, updating your estate plan or getting an estate plan, general planning, the tried and true general financial planning that we do on a regular basis. And don't forget distribution planning and Roth IRAs. These are the key takeaways for 2021 and beyond. If you have questions, please reach out to me at 925-355-1588 or send me an email. We look forward to hearing from you and hope you found today's information useful.